You know that feeling when everyone around you seems to have figured something out, and you're still standing at the starting line feeling completely lost? That's how most people feel about investing. You hear your coworkers talking about their portfolios. You see influencers posting about compound interest. And meanwhile, you're sitting there with money in your checking account, wondering where to even begin. The worst part? Every day you wait feels like you're falling further behind. You open investing apps and they throw dozens of options at you with no explanation. You read articles that use terms like diversification and asset allocation like you're supposed to already know what they mean. So you close the app. Tell yourself you'll figure it out later, and the cycle continues. But here's the thing. Investing isn't actually complicated once someone breaks it down step by step in plain English. That's exactly what I'm going to do today. By the end of this video, you're going to know exactly how to start investing, what to invest in, and how to avoid the mistakes that trip up most beginners. Let's start from the very beginning, and I mean the actual beginning before you invest a single dollar. The first thing you need to do is make sure you're ready to invest. I know that sounds boring, but hear me out because skipping this step is how people get into trouble. Before you invest, you should have two things sorted out. First, you need an emergency fund. This is money set aside in a regular savings account that you can access immediately if something goes wrong. Think about what would happen if your car broke down tomorrow, or you had a medical emergency, or you lost your job. You need cash available to handle life's surprises without having to sell your investments at the wrong time. Most experts suggest having 3 to 6 months of living expenses saved up, but honestly, even 1 month is a good starting point. If you don't have this yet, focus on building it first. Second, you should pay off any high-interest debt, especially credit card debt. If you're paying 18% interest on a credit card balance, that's eating away at your money faster than most investments could grow it. It makes more mathematical sense to pay that off before investing. Now, this doesn't mean you need to pay off everything. If you have a low-interest student loan or car payment, you can often invest while paying those down. But high-interest debt should be your priority. Once those basics are handled, it's time to actually start investing. And the first real step is opening a brokerage account. Think of a brokerage as the middleman that lets you buy and sell investments. You can't just call up Apple and buy their stock directly. You need to go through a brokerage. Now, there are tons of brokerages out there, and honestly, most of the major ones are pretty similar these days. Companies like Fidelity, Charles Schwab, and Vanguard are the old reliable names that have been around forever. Then you have newer apps like Robinhood, Webull, and Public that make everything really simple and mobile-friendly. For most beginners, I'd lean toward the established companies because they offer more resources and education, but the newer apps work fine too. The good news is, almost all of them have eliminated trading fees, so you won't pay commissions when you buy or sell. Most also have no minimum deposit, which means you can open an account with whatever amount you have. Opening the account itself is straightforward. You go to their website or download their app, click to open a new account. They'll ask for basic information, like your name, address, social security number, and employment info. This is normal because they're required by law to verify your identity. You'll also need to link your bank account so you can transfer money in and out. The whole process usually takes less than 15 minutes, and your account is often approved within a day or two. Now, when you're opening the account, you might see different account types listed, and this is where people start to get confused. The main one you'll see is something called a taxable brokerage account, which is just a regular investment account. You put money in, you invest it, and when you eventually sell investments for a profit, you'll pay taxes on those gains. But you might also see retirement accounts like a Roth IRA or a traditional IRA. These have special tax advantages designed to help you save for retirement. With a Roth IRA, you put in money that you've already paid taxes on, and then it grows tax-free forever. When you retire and take the money out, you don't owe any taxes on it. With a traditional IRA, you get a tax deduction now for the money you put in, but you'll pay taxes when you withdraw it in retirement. If you're investing for retirement and you're eligible for an IRA, it's usually smart to use one because of these tax benefits. But if you want access to your money before retirement without penalties, a regular taxable account gives you more flexibility. Now comes the part that overwhelms most people: deciding what to actually invest in. You open your account, transfer in some money, and then you're staring at thousands of options with no idea which ones to pick. Here's what you need to understand. You don't need to pick individual stocks. In fact, for most beginners, trying to pick individual companies is a mistake. You'd be competing against professional investors with teams of analysts and sophisticated algorithms. And let's be honest, you're probably not going to beat them consistently. The smarter approach is to invest in index funds. An index fund is a type of investment that holds a little bit of hundreds or thousands of different companies all at once. The most popular ones track the S&P 500, which is basically the 500 largest companies in America. When you buy an S&P 500 index fund, you're instantly getting a tiny piece of Apple, Microsoft, Amazon, Google, Tesla, and hundreds of others all in one purchase. This is called diversification, and it's your best friend as an investor. Instead of betting everything on one or two companies, you're spreading your money across the entire market. Let me give you some actual examples of index funds you might invest in. One of the most popular is VOO, which is offered by Vanguard and tracks the S&P 500. There's also SPY and IVV, which do basically the same thing but are offered by different companies. These give you exposure to large U.S. companies. If you want even broader diversification, you could look at something like VTI, which holds basically the entire U.S. stock market, including smaller companies too. And if you want global exposure, there are funds like VXUS that invest in companies outside the United States. The beauty of index funds is that they're low cost. They charge what's called an expense ratio, which is basically a small annual fee for managing the fund. Good index funds charge less than 0.1% per year, which means on a $10,000 investment, you'd pay less than $10 annually. Compare that to some actively managed funds that charge 1% or more, and you can see why index funds are so popular. So let's walk through what it actually looks like to make your first investment. You've opened your account, you've transferred money in, and now you're ready to buy. We'll search for the fund you want. Let's say VOO as an example. The screen will show you information about it, including the current price. Now here's something that confuses people. Index funds are bought and sold just like stocks, which means they have a price per share. VOO might be trading at $400 per share. If you have $1,000 to invest, you could buy 2 full shares. Some brokerages now offer fractional shares, which means you can buy a portion of a share, so you could invest your full $1,000, even if the math doesn't work out perfectly. You'll enter how much you want to buy, review the order to make sure everything looks right, and then submit it. Congratulations, you're now an investor. Your money is now invested in hundreds of companies, and as those companies grow over time, the value of your investment should grow too. But here's where the strategy really matters. The key to successful investing isn't about finding the perfect moment to buy or trying to time the market. It's about consistency. This is where dollar cost averaging comes in, which is just a fancy term for investing a set amount of money on a regular schedule, like every month. Let's say you decide to invest $300 every month. Some months the market will be high, so your $300 will buy fewer shares. So other months the market will be lower, so you'll buy more shares. Over time, this averages out and takes the emotion and guesswork out of investing. You're not trying to predict whether the market will go up or down next week. You're just consistently putting money to work. This approach is powerful because it builds a habit and removes the paralysis that comes from trying to find the perfect entry point. Now, let's talk about what happens after you invest, because this is where a lot of beginners make mistakes. You buy your index fund, and then you check your account the next day, and you see that you're down $50. Your first instinct might be to panic and sell. Don't do this. The market goes up and down every single day. Sometimes it drops 10 or 20% over a few months. This is completely normal and part of investing. The worst thing you can do is sell when the market drops because you're locking in those losses. Remember, you haven't actually lost money until you sell. If you just hold on and wait, history shows that the market recovers and continues growing over the long term. The stock market has gone through world wars, recessions, pandemics, and every crisis you can imagine. And over long periods, it's still trended upward.
Okay.
This is why investing is a long-term game. If you're going to need your money in a year or two, the stock market isn't the right place for it because there's too much short-term volatility. But if you're investing for 10, 20, or 30 years, those short-term drops become tiny blips on the chart. Let me give you a real example that drives this home. Imagine someone invested $10,000 in an S&P 500 index fund at the beginning of 2008, right before the financial crisis hit. By early 2009, that investment would have been worth maybe $6,000. They would have been down 40%. If they panicked and sold, they'd have locked in a $4,000 loss. But if they just held on and kept investing through the downturn, by 2015 they'd be back to even, and by 2020, that original $10,000 would have grown to over $25,000. The people who won were the ones who stayed calm and stuck to their plan. Speaking of plans, you should think about your asset allocation, which just means how you divide your money between different types of investments. The main split most people think about is between stocks and bonds. Stocks are ownership in companies, and they have higher potential returns, but also more risk and volatility. Bonds are basically loans to governments or companies, and they're more stable but grow more slowly. When you're young and have decades until retirement, most experts suggest having most of your money in stocks because you have time to ride out the volatility and benefit from higher growth. A common rule of thumb is to subtract your age from 100, and that's the percentage you should have in stocks. So if you're 30, you might aim for 70% stocks and 30% bonds. But honestly, when you're just starting out and investing small amounts, keeping it simple with just a stock index fund is perfectly fine. You can get fancier with your allocation as you learn more and build up your portfolio. One more thing that trips people up is wondering whether they should invest a lump sum all at once or spread it out. Let's say you just got a $5,000 bonus. Should you invest it all today or invest $1,000 a month for 5 months? Mathematically, investing it all at once usually wins because the market tends to go up over time. So the sooner your money is invested, the sooner it can start growing. But psychologically, spreading it out can feel less scary, especially for beginners. And honestly, the difference isn't huge. The most important thing is that you're investing, period. Don't let perfect be the enemy of good. As you continue on this journey, you'll want to check in on your investments occasionally, but not obsessively. I'd suggest reviewing your account maybe once a quarter or even just twice a year. Make sure you're still on track with your goals. Rebalance if needed. It just means adjusting your investments back to your target allocation and keep contributing regularly. But resist the urge to check your balance every day, because that'll just stress you out with all the normal ups and downs. Set up automatic contributions if your brokerage allows it, so money gets invested every month without you having to think about it. This automation is honestly one of the best things you can do because it removes the decision fatigue and keeps you consistent even when the market is scary. I also want to mention that investing isn't all or nothing. You don't have to invest every spare dollar you have. It's okay to invest for the future while also spending money on things you enjoy today. The goal is balance. Maybe you invest 15% of your income and use the rest for living your life. That's totally fine. The important thing is that you're making progress and building wealth over time, even if it feels slow at the start. Remember, someone who starts investing $200 a month at age 25 and continues until 65 will end up with significantly more wealth than someone who starts investing $1,000 a month at age 45, even though the second person invested way more total dollars. Time is the most powerful tool you have. Before we wrap up, let me be clear that everything I've covered today is for educational purposes and not financial advice. I'm not a financial advisor, and your personal situation is unique. You should do your own research and consider consulting with a professional who can look at your specific circumstances. But my goal here was to give you a clear roadmap that takes the mystery out of investing and shows you that it's something you absolutely can do. So here's your action plan. First, make sure you have at least some emergency savings and aren't drowning in high-interest debt. Then open a brokerage account with a reputable company. Decide whether you want a regular taxable account or a retirement account like a Roth IRA. Transfer in whatever amount you can afford to invest. Even if it's just $50 or $100 to start. Buy a low-cost index fund like VO or VTI that gives you broad market exposure. Set up automatic monthly contributions so you're consistently investing. And then be patient, stay consistent, and let time do the heavy lifting. You're not going to get rich overnight, but over years and decades, this simple strategy can build real wealth. If this video helped you understand how to actually get started with investing, I'd love it if you hit the like button so more people can find this information. And if you want to keep learning about money, investing, building wealth in a way that's actually clear and practical, go ahead and subscribe to the channel. In the next video, We're going to talk about common investing mistakes that cost people thousands of dollars and how to avoid them. Thanks so much for watching, and I'll see you in the next one.